And this is Anthony Mento at Life Brokerage. Thank you for taking some time out of your afternoon for us folks here on the East Coast, and good morning to our friends out west and in the Midwest. We put together a lot of content here for you today that we're going to share in a very short period of time. So we have a pretty good audience today, about 87 attendees. So we're not going to open up the question and answer to voice, but rather type. So if you have questions along the way, in your control panel, there is a question button where you may submit them, and I promise to do as best job as I can to answer each and every one. And of course, myself and the folks here at Life Brokerage are available after the call. For those of you who are control freaks, we have put together an agenda here that we're going to follow very tightly. 12 to 12:15, we're going to set up the retirement crisis and get into assets needed to retire, longevity risk, behavioral sequence matters. This is going to set the stage for using whole life insurance or low cost, low fee index universal life products that have floors or close to a floor without asset-based charges. 12:15 to 12:20, we'll spend about 5 minutes on making the case for permanent life insurance and why a retirement plan would be very simply better with cash value life insurance than without. Spend another 5 minutes on wealth creation. This is kind of the crux of the invitation that we sent out to try and pique your interest. We've built a model that showcases a modern day be your own banker strategy, and then get into some of the software and how we can help you quantify this story to your clients. So we're going to move pretty quickly. Key learning objectives today, in particular, the most common retirement planning mistake clients make is that they pull money out of their portfolio at a rate of return before actually even knowing the rate of return. I'll get into the mechanics of this. Most clients never insulate themselves or protect against markets going up and down. And longevity risk is real. So these are your key learning objectives today. If you take anything away from this presentation, it would be this chart and how the vast majority of society uses the Monte Carlo withdrawal system, which is down the bottom. They accumulate a bunch of equities inside their 401k and mutual funds and bonds, and at a 3% distribution rate, in order to generate $100,000 of lifetime income that would last them a period of 30 years or more, they would need to save $3.3 million of assets to generate that income. 401ks, mutual funds, equities, wonderful accumulation tool. We need them to be able to accumulate assets or enough assets to be able to afford to retire, but they're terrible distribution tools. And we'll get into why and sequence of returns and how actuarial science products like cash value life insurance or immediate annuities distribute much better. So using actuarial science products actually require far less assets to be able to afford $100,000 of lifestyle or lifetime income 30 years into retirement. Very simply put, you need both. You need banks and wirehouses, and you also need actuarial science. So rather than driving $1 million of savings into a 401k and distributing at 3.5%, what our software suggests is that you drive $750,000 into a 401k, acquire a 1-to-1 ratio of permanent death benefit of $750,000, and accompanying that $750,000 of death benefit represents $250,000 of cash value. So by having the life insurance in the portfolio, just very high level conceptual here, allows you to withdraw at 6% because you have a volatility buffer in your cash value, and your retirement income increases from $35,000 to $45,000. So again, very high level. Wanted to drive home this point before we dig into the details. So You know, I think the industry itself, you know, I'm obviously an insurance professional and an insurance wholesaler, so you know, I don't think clients really want to hear from me my philosophical beliefs. So we do a really nice job of using the industry and the banks and wirehouses to help tell our story. And you know, you're going to see a few references. I'm happy to share these third-party materials. JP Morgan's Guide to Retirement, the 2020 edition, is about to hit print, but you know, in essence, there are really six pieces of the retirement equation, and the only two you can control are asset allocation and location, and your savings versus spending. So you can make the most of things that you can control, and everything else you just kind of have to evaluate and kind of deal with as market conditions present themselves. So if we know that we can't really control longevity, straight from JP Morgan, Social Security Administration, in essence, if you are a married couple, age 65, there is a 48% probability that one of you are going to get to age 90. So part of the retirement crisis is that folks are running out of money. You know, you have reverse legacies, you have baby boomers running out of money, getting sick, and moving back in with their children. So you better position the portfolio to last you at least 30 years into retirement. What you'll see here is that when you're trying to define a retirement income goal, we're approximating about 74% of your current income is going to be needed in retirement. So we need 74% of our current income to last 30 years into retirement. And what this chart just is reflective of is that you're gonna save 6% less in your retirement accounts. You're gonna adjust your expenditures by about 8%. You're gonna pay approximately 11% less in taxes, and Social Security is going to replace some of your retirement needs. Bigger earners, bigger savings. Very simple. When you look at society as a whole, and the Secure Act that just was passed through Congress kind of speaks to this, is that the vast majority of retirement assets are held in 401k plans, and the majority, if you look at the breakdown of percentage of retirement assets in stocks and bonds, virtually all the assets are held in either equity funds, target date funds, non-target date funds, or bond funds. When you look at portfolio incomes and distribution rates, right? The banks and wires constantly are chasing yield in accumulation. And then you get to the top of the mountain and you have a bunch of assets at retirement, and then you're kind of left to figure it out on your own. Distribution rate arguably is a more important part of the equation than the accumulation rate. And what this chart shows you is that at varying distribution rates, 3, 4, 5, 6, 7, and 8%, probabilities of not running out of money. And the chart will give you 5-year increments from starting in 15 years into retirement, moving to 20 years into retirement, 25, 30, and 35 years into retirement. And you'll see at a 5% distribution rate, you basically had a coin flip to get 35 years out into retirement. Common response we get is, look, stocks and bonds are negatively correlated, and we'll just get a little more conservative as we get older. And yeah, I don't have to worry about all that sequence and volatility. Well, that's actually false. In the last 50 years, both stocks and bonds have been down together an average of every 2 of 10 years. And this chart here, there's this great article by Susie Orman, who is like the antichrist when it comes to life insurance. Great article she put out this month. Happy to share it with you that the 60-40 allocation is dead. And they were her words, right? Because interest rate and risk frees are so low, you can't possibly get the duration that you need in your portfolio if you're allocated in. So the theory of getting more conservative, right, and moving into more bonds or fixed instrument vehicles is actually not true. And if you look at the 4% withdrawal rate, actually the optimal portfolio is 50-50, right? 50 stocks, 50 bonds. And the more you move into bonds, the lower the probability is that your portfolio is going to make it 30 years. You're just not getting the yields in the bond portfolio, and inflation rates are kicking in, and it's just not possible anymore. You know, I mentioned to the guys in my office yesterday, when I came into the business, I met with an older couple in Vineland in New Jersey who had laddered CDs, right? And they're earning anywhere between 5 and 6%. So every $1 million of CDs would generate 60,000 of retirement income, and I never touched the principal. But we're obviously in a very different world today. And this chart, again, taking it right from the horse's mouth, a 40-60 portfolio at 4, 5, and 6% distribution rates just don't get you out the 30 years that you're going to need. And if you try and backpedal and move more into a bond portfolio, I'm showing you the difference between 40-60 and 20-80, you're actually running out of money even sooner. Here's a heat map showing, and you know, the green really tells you the story that you really can't withdraw any more than 3% of your portfolios. You know, so every $1 million is going to yield, call it $30,000 of retirement income, unless you start to incorporate and insulate against downturns or poor sequence in retirement. And this is where the products that we sell come into play. Wonderful piece here. This is ahead of Morningstar, basically saying that the 4% rule, I believe it was Mr. Bengen that came up with the 4% rule that says 4% withdrawal rate, you can sustain a portfolio into retirement 30 years. Well, here's the head of Morningstar basically telling us that we cannot continue to assume historical averages, 10% large caps and 5% treasuries, and the 4% rule is outdated and no longer appropriate. And the American College is actually doing a really good job of educating their students in the retirement income certification course about distribution rates and how a more appropriate distribution rate today is 2.56%, and they have the mathematics to back it up. But I won't, I won't debate that on today's call. The point we want to make is that the industry, the banks and wires, are telling us that 4% is no longer a good assumption. So we should start to back this down. One of the reasons 4% isn't actually a relevant number is that you have behavioral risk. Dalbar does a great study on 9 behavioral risks that cause investors to act irrationally. So they're basically doing things at the wrong time, and it leads to underperformance. But what I'm showing you here is quite interesting. On the far left, 2018, the S&P was actually down 4.38%. But if you look in the middle, the average equity fund investor was down minus 9.42%. And that's because of behavior. If you look at the far right, the Bloomberg Barclays aggregate bond index was flat, yet the average fixed income investor was down 2.84. And again, that's because of consumer behavior. This is another great piece from JP Morgan. The S&P between 1999 and 2018 returned 5.62%. If you missed the 10 best days, right? Yeah, we had a rough week on Wall Street. I know folks that have jumped out just out of fear. If you missed the 10 best days of the market in that 20-year period, right? We're talking like less than 1 day a year. Like you just missed 10 days, your yield goes from 5.62 down to 2%. So we need, as insurance professionals, to be able to hedge against these down markets and create less reactivity against negative consumer behavior. So other resources, I'll be happy to share these slides. Other resources you're going to want to utilize is the Vanguard Retirement Nest Egg. It simulates how long your portfolio will last given your age and various distribution rates. If you put in a 4% distribution rate, it'll show you how long you're going to last based on your allocation. Fidelity also has a wonderful tool, shows sustainable withdrawal rates, and the Society of Actuaries puts out an interesting tool to actually predict how long you and your spouse will live into retirement. So here we are planning for a down market, right? we're constantly getting inconsistent financial advice. You know, I could walk into any particular client can make 2 appointments with 2 very different financial advisors. You have $20 million in a checking account. You walk into Merrill Lynch, we're going to invest it 75-25. We're going to build this derivative, and you're going to be able to expect 7% yields, and you're going to buy some term insurance. Your second appointment at with his financial advisors at the Guardian Agency, they're going to take that $20 million. We're going to buy a $2 million 10-pay. We're going to increase all your deductibles. We're going to do all these cool things, and we're going to hedge against all of your risks. So what in the world just happened? I met with 2 financial planners. They gave me 2 completely different pieces of advice. You know, I have banks and wirehouses who are chasing yield and rates of return. And then I have insurance companies in actuarial science chasing mortality risk and pooling risks. I'm confused. Who provides better solutions? And the reality is you actually need both superpowers to effectively accumulate and distribute retirement income. You cannot afford to retire if you invest in all insurance products because the charges in the early years are too high. Your yields aren't very good, to be quite frank. However, when you reach retirement age, you can't afford to be in 100% equities because those products simply don't distribute well because of sequence of return risk and market volatility, inflation. So if you combine the 2, you optimize your accumulating your assets to get to the top of the mountain, and from that point, the actuarial products step in and help you distribute all the way down without behavioral risk. One thing we can bank on is that we're in for a world of uncertainty, particularly in the next 10 years. And I would suggest that in the next upcoming 12 months, there could be some more uncertainty that we're not typically looking to embrace. So optimal planning, 1-to-1 ratio of equity portfolio and permanent life insurance, cash value permanent life insurance, which allows us to do one of 2 things. Implement the covered asset strategy, which permits us to annuitize some of the equities and get the highest distribution rates in the industry through a single premium immediate annuity. Or what we're going to talk about today is a volatility buffer where we can take tax-free withdrawals non-correlated to the market in the year following a down market return. So the year following, I do not need a crystal ball. If the S&P is down 10%, I'm going to take from my volatility buffer in the year following. I want staying power. I want the equities to be able to recover. That's the story I'm going to make here. I'm going to tell here. Sequence does matter. And if you see 1 or 2 consecutive down years, they're typically followed by a very good year. So if you had staying power, if you had a buffer to pull from or tap as a percentage of your retirement income in these down years, your portfolio will last significantly longer. We do a really nice job. One of the pieces I wanted to showcase to you today that we can customize this particular this sequence of return to your client age and starting value and years of analysis. So here's a 40-year-old starts with $100,000. We took the actual returns of the S&P 500, and down the left-hand column, portfolio A returned 8%. My $100,000 grew to $615,000. Very simply, I took the exact same returns and I reversed them. I'm trying to tell the story of sequence. Sequence does matter. The actual returns, I started off poorly and I finished strong. Now I'm going to actually reverse that. It doesn't matter. In the bottom left-hand corner of the page, you see no difference. When you're accumulating assets, you want an 8% yield. However you get to 8%, it doesn't matter. It's the same result. Conversely, if you move over to the right side of the page and you're taking withdrawals and distributions at a 5% distribution rate, actual performance, the S&P 500 and portfolio A is on the left side. You see I got a bad start, good finish, ran out of money by age 77. You don't want to start off poorly in your initial retirement years because that's when you have the most amount of money to lose. If I take portfolio A and I completely reverse it, staying power all the way through age 90 with $1.2 million still left in the tank. To customize the sequence output, anytime available by agent request. You send us a client age, how many years you want the data for. We pre-programmed a pretty intense Excel file for analysis to do 30, 40, 50, and 60 years. Same story we just told. The greatest risk is the year you enter retirement because you have the most amount of assets to lose. And this is, again, not coming from me, not coming from Mass Mutual, not coming from Penn Mutual, not coming from John Hancock. It's coming from BlackRock. Very simple story here, and then we'll dive into the heart of the presentation and how we've arrived at the software solution. So, $1 million retiree in 1973, average S&P return is 6.7%. Client says, okay, if I got a return of 6.7, I would think I could take a 7% distribution rate. I'll mildly impact the principal, but I certainly won't run out of money. And during those 20 years, 15 of the years the market was up, and 5 years the market was down. What I'm showing you here is that we got off to a poor sequence. The first year has a -14, second year was a -26, and even though I averaged a 6.7% return over those 20 years, I couldn't withdraw at a 7% distribution rate. The portfolio was eroded by over 56%. So what do? We start planning with use of a volatility buffer. There are 3 types of volatility buffers. There's a line of credit on reverse mortgage, there's cash value life insurance, and then there's straight cash. There are only 3 types of buffer assets. The buffer concept is that if you skip a year following a down market, then the 4% rule can be actually increased to a 5 or 6 or 7% rule, because I have a buffer against down markets and I'm insulated from 1, 2, 3, 4, 5, or 6 years of poor sequence. So if I show you all distributions, there was no buffer whatsoever. You see the portfolio crashes and burns by 1995 in this particular example, beginning in 1966, ending in 1995. If I have 1 year of buffer and I skip 1967, you see the impact of still having close to $1 million in the portfolio. If I skip 1975, just 1 year of $1.3 million of staying power in the portfolio versus 0 in the all distribution, no buffer strategy. This piece is put out by Dr. Wade Pfau. He's a very well-known professor of doctorate in economics at the American College. So we told you what a volatility buffer is. We're looking to insulate ourselves against sequence. I'm going to go back to the same exact example where we just blacked out the years of following a negative return in the S&P and utilized our volatility buffer. And the difference in eliminating those 5 down years is $3.6 million of remaining portfolio value at age 85 versus $446,000 if I didn't use a buffer. So we're setting the table for utilizing cash value whole life insurance as a volatility buffer, incorporating it into a retirement plan is certainly more effective than not. The solution, very simply, permanent cash value life insurance as a non-correlated asset. Talked in the beginning about using low-cost IUL, preferably with an asset charge of 2% or less. Right? Negative returns in the product are certainly not efficient and actually beats the purpose. So here's a one-pager as flavor of choice. You have whole life and you have index UL. So let's get to, we set the table for optimizing retirement, right? So what other cool things can I do with this? Here is the reason for today's call. If you have a cash-rich, tax-deferred, compounding growth life insurance product and an opportunity in investments or business present itself, and you are properly using that particular cash value life insurance policy, you can capitalize on opportunistic investments at the drop of a dime. Cash value life insurance can be used as a collateral vehicle to many banks across the United States to set up working lines of credit. What we're finding in the old day, be your own banker used non-direct recognition whole life policies and using the actual policies to borrow. We've discovered that that's no longer efficient. A, rates are too high within the policy loans, and B, continuous compounding, meaning unimpeded growth within your policy, always beats thwarted compounding or stalled compounding. You want to avoid breaking momentum so that you can do all the things we just talked about later on in life using it as a volatility buffer. So leaving the whole life or the IUL to compound and not impeding its growth optimizes the result. So what I'm showing you here is if I have a bucket of money or a war chest of money that I can take to my local bank, and there are several national programs that we can certainly put you onto. There are several banks even in attendance at AALU meetings and industry events. Prime rate history is typically much less by 100 to 200 basis points on average than the Moody's corporate bond rate, which is what most whole life policy loan rates are tied to. I would also suggest that any indexed universal life policy will allow participating loans at 5 or 6%. Prime is, again, much less than participating loan rates. Participating loan rates are somewhat riskier. And there are a host of reasons why whole life line of credit banking environment is a more attractive vehicle to go out and utilize leverage to fund your alternative investments. So if you survey the whole life line of credit banking environment, which is somewhat common in today's world, the approximate rates between $65,000 and $250,000 of credit is prime minus 50. I don't know of a whole life policy or participating loan rate anywhere close to 4.25% today. And that 4.25% may be tax deductible. On larger rates, larger lines of credit, up to $1 million is actually prime minus 1, so 3.75. So I'm picking up anywhere from 125 to 300 basis points in utilizing the policy as a collateral with an outside bank than taking the loan directly from the insurance company. Ease of administration. Lines of credit from $65,000 to $5 million, no app fee, no closing costs, no prepayment penalty. I mean, this gets set up in 4 to 5 days. Software solution. So this has always been a great story. There have been books written about Be Your Own Banker. There's been articles written, but I've never seen anyone be able to quantify how it works. What I'm showing you here is a model that we've built along with some pretty sophisticated programmers that are all plug and play. They're one click from various insurance software solutions that tell the story from left to right in a one-page format that we would brand in the agent's colors and logo. What you're looking at here is a 7-pay whole life contract, lots of flexible term rider, lots of paid up additions. We're trying to create a bucket of income as quickly as we can. And what the policy values are going to enable us to do is to go out and secure bank financing to then invest in an alternative investment. And I'm going to break this down. It did the best we could. It's a 50-year analysis. Did the best we could to visualize all 16 columns, but I'll break it down for you in quadrants. So the policy values are here and displayed in columns 1 through 6, first 20 years of the policy. Pretty good returns based on current dividend assumptions. And we are product agnostic, so we're not looking to push any one particular carrier or strategy. Whole life, IUL, it's really flavor of your choice. Now, once I have these policy values, I can then go out to any one of these national banks and borrow up to 90% loan to value at an assumed rate of 4%. You know, the actual rate today is 3.25. So I put a little buffer in here and I just assume the 4% rate of return. And what I'm showing is that in year 6, an opportunistic investor identifies something or someone they want to invest in. We just had 3,000 point downturn in the market. One would argue that everything is opportunistic right now. You know, you have a distressed piece of real estate. You have a small business. 90% of the cash value can be loaned, up to 90% of the cash value can be loaned. Service the annual loan cost, which again could be income tax deductible. And I'm assuming that this particular astute investor, entrepreneur, repays the bank loan every 5 years in column 9 and then repeats the process again. 90%, policy values, 2.3 million. I service the interest of 93,000, likely tax deductible, and I repay the bank loan at the end of year 5. And I repeat the process again. So what I'm showing is the ability to have 2 assets growing at the same time, your whole life policy unimpeded, and your alternative investments. Showing you that we're questioning the consumer, what is your pre-tax yield on expected pre-tax yield on my alternative investment? Well, if I put it back into my business and I hire 4 sales guys, I could generate a 17% rate of return. Well, Mr. Client, why don't we back that down to 12 pre-tax, 8% after tax, and we're going to show you the cumulative gain in column 14 on the arbitrage of that alternative investment. Column 15 will show and quantify the policy values plus the cumulative investment gain on the alternative investment in column 14. Column 16 takes the death benefit into account. Nice little visual. Your foundation of the whole life policy is growing unimpeded. You don't see any spike. You don't see any ups and downs. You're showing that the whole life policy is the catalyst for us being able to grow alternative assets. And the light blue represents the cumulative gain on the alternative investment. By year 2069, we approach a number of $65 million of wealth created on a $2.1 million whole life investment. Tell the same story in death benefit. Similar story here, your credit payments of approximately $9 million and your alternative investment growth of $55 million. You now have a software solution that can actually quantify the story of Be Your Own Banker, where we're using third-party lending versus an insurance company's general account loan fund. Three minutes over. I'd be happy to answer any questions. Again, because of the number of attendees on today's call, we'd prefer that you type your questions. Be happy to answer each and every one of them, or we're available to jump on a call immediately following or in the days upcoming in the next couple of weeks. First question from John is, we'll be able to share the presentation? Absolutely. If you need anything customized, we can certainly customize per client. Second question is, are we pulling the interest payments on the bank from the policy? No. We typically like to service the interest payments. We believe that if they're in conjunction with a trade or business, that those payments would be tax deductible. So we want to certainly take advantage of that, and we don't want to stress the policy with unnecessary withdrawals early in the contract. Very good question. Third question, the language sounds like wealth building cornerstones. Yes, a lot of our presentation here incorporates the core principles of wealth building cornerstones. Some incorporate LEAP, and some we've just kind of derived on our own experiences. Yes, big supporter of Wealth Building Cornerstone. Very good questions. So as we approach 35 past the hour, I want to thank everyone for attending today. This call and webinar was recorded, so we can certainly make this available to you. Copies of slides will also be circulated to the attendees, and please do not hesitate to contact us with any custom case design requests or follow-up questions. That'll conclude today's call. Thank you for joining.